Hello, everybody. Welcome back to the Mouthy Money podcast. I am joined as ever by my good colleague and co-host, Chris Tuite, who is head of consumer finance at communications consultancy MRM. Chris, hello.
Hi Ed, how's it going?
Yes, lovely. We are recording this on a Friday afternoon, which is quite exciting. I am also launching a new pair of glasses. I don't know if you noticed.
There we go. I didn't get the release. Amazing.
Yeah, I know.
Unveiled.
It's a hard launch. We're just going for it.
Who
A
are you
new pair,
who are you partnering with these new specs, Ed?
partnering with Qubits, my good friends at Qubits, who have not paid me to promote them. I paid them.
Oh, well,
So
that's the wrong way around.
for anybody listening to us on Spotify or Apple, this isn't going to be an absolute mystery, but for those of you on YouTube, please do let me know in the comments what you think of my new glasses. What are we talking about today? Well, this is a little bit of a part two in a two-part ish special. That what we were looking at last week was the fact that my house price isn't looking quite as healthy as it might have done, and the kind of the nervousness that I've got around that and my personal story. But today, we did last week look a little bit at kind of what's going on in the wider property market, but I think we kind of alluded to it more than got stuck into any of the details. So today we're going to get a bit more stuck into the detail of what's going on out there in the property market, why some of the data might not be reflecting, what the conditions are like on the ground. And then we're also going to think about, well, if property prices really are genuinely going down, who is this bad for? Who is this good for? And then what might some people and institutions, let's call them, be doing about that? Is that fair to say, Chris?
That's absolutely spot on. Yeah.
Yeah.
What's the reality of it out there on the ground? I mean, we obviously talked about your personal situation and a bit of mine, and that's all very relevant. And also what's going on in prime central London is that canary down the mine, but actually, a bit of a broader brushstroke on what can we do about, or should we do about it, I think is
Yeah,
the right next step.
let's start with that canary then, Chris. Just explain for us what there's stuff happening in the London prime market. The prime market is. Explain for me what the prime market is, and tell me why is that a bit of a canary for the rest of the property market?
So the London prime market, London international city, right? So it has attracted down the years, for many years, a lot of outside investment in a number of different things, but also property from sort of global investors, partly because people want to come and live here because it's a great place to live. And they also want to, run businesses and do all that kind of good stuff. But also because the UK generally has that kind of political stability, rule of law, all that kind of good stuff. So if you're an international international person who's got money to invest in property around the world, London traditionally has been a good place to do that because of all those various protections. And it's been a market that's performed well. However, because of that element of it, you do end up with it being an indicator or potentially a lead indicator of how the wider UK property market is looking when those individuals stop buying property or investing in it, and you start to see demand fall off, or you start to see prices starting to fall. It can often suggest that there's weakening demand throughout the rest of the London property market. And then because of the London market, the rest of the country can then follow in that regard, because London's also been a leading indicator for the rest of the country. So you've got normal people, if you like me, who sort of are lucky enough to have been able to get some property in London, and separate from that prime market. We're talking, the luxury flats, the high rises in the middle of Battersea. We're talking, townhouses in Mayfair, that kind of good stuff. So real, in the millions. There's millions and squillions. That's the kind of the definition of it, I suppose. Probably not a technical one, but it gives you an idea.
But there is an appreciable kind of phenomenon here, right, where we've had property price crashes in the past, and that tends to be presaged by this bit of the market suddenly looking all a bit wrong. Do you reckon, is that because these are very sophisticated buyers who see, or sellers even, who see what's going on and kind of move ahead of the crowd? Do you think that's probably what's happening here?
I think it tends to be a bit of a precursor to economic headwinds.
Mm.
So, the main examples I can think of where this has definitely been the case was during the inflation price shock of the 70s, to which there were many parallels to what we've got at the moment with the cost of living crisis and all the rest of it. And what you saw then was high net worth individuals moving out of the London property market because they didn't want to invest their cash in that kind of thing. And that did lead to a fall there, and then did lead to a wider house price crash. You then had, in the sort of late 80s, early 90s, there was an interest rate spike, and house prices went up, and there was a lot of repossessions around that time. Same thing. There was a precursor of prime central London prices falling a matter of months before the impact being felt with the rest of it. So the stone dropped in prime London and then rippled out. The last two occasions of sort of property downturns, major property downturns, or probably a little bit more of a grey area because you had the global financial crisis. Unfortunately, I'm old enough to remember that well. I was working at the time, where you had the credit crunch, where you had sort of subprime mortgages who'd been turned into kind of credit default swaps and all that kind of stuff. There was too much exposure to property markets in the US for certain banks, and turned out they all had massive holes in their balance sheet they weren't aware of because they'd overvalued those assets, and everything started to collapse a wee bit. But the difference, I think, is that we did see a sort of correction or a downturn, but it wasn't long lasting because the UK was an international venue at that point, still in the EU, still trading well economically, and London was still a destination for a lot of financial firms, property firms, investors, and was attracting a lot of international money from across the world. Fast forward to now, you've got Brexit has reduced the inflow of firms wanting to do business here potentially, and also of that foreign influence coming in. You've got the geopolitical situation changing. We had a lot of Russians over here at that time who were investing money in that prime space. They're not here now because of the situation between the West and Russia as it stands. You've also got, the general kind of economic position. So we've had COVID, we've had lots of hits, lack of growth, and the economy isn't doing as well as it perhaps was back then. And so you combine all of that, and all of a sudden, if you're looking to drop 80 million quid on a penthouse head, which I think you're not, but you may want to tell me, as your London pad, you might think, well, maybe I'm better off doing that somewhere else. And so there's lots of, one of the indicators that we saw in a piece that I referenced in the last pod by John Stepek of Bloomberg is that you've seen a lot of high net worth developments that are standing empty or haven't been able to shift those units, those houses, those flats, those bits for the prices that they want to. And then you see that kind of rippling further out. The other thing to mention as well is this, and it's probably less of a factor, but it's quite interesting. You do have a lot of short-term lets in central London because it's a tourist city, it's an international city. And what you're seeing is those kind of, it's the Renters Reform Bill has made it a little bit more difficult for people to be able to have tenants in. Makes it a little bit more arduous. There's more hoops to jump through. There's positives for that. There's negatives for that. But also, changes around rules when it comes to short-term lets, or the position of that has made that a little bit more unclear, which means even if you wanted to Airbnb something that isn't a multi-million-pound penthouse, but is actually, a £600,000 two-bed flat in Bloomsbury, that suddenly becomes a little bit more difficult as well. So people might be thinking it's time for me to cash in on this asset and do something else with my money. And yeah, that could ripple out, because if things are cheaper in central London, then maybe people might be more willing to buy there than they are towards the outskirts where I am, which means that demand for my house might fall. And that's the interesting bit, actually, and I'll stop talking now, is how connected are those worlds now? So, if you're wanting to raise a family in London, are you going to move into Bloomsbury? Probably not. You're probably, what does that
I
do to
think that,
demand?
yeah, I think that's one of the most interesting and things about the property market that people don't talk about, actually. And there's always this thing about when they build like prime central London, like the Battersea style developments and that kind of stuff, and then the local council, whoever it is, forces part of the development to be kind of affordable housing and that kind of thing. I think what's interesting, the effect with that is, and sometimes they get a little bit back to front, where it's like, well, if you build like really prime houses for millionaires to go and live in, those millionaires have to leave somewhere else, and that opens up other bits of the market elsewhere, and actually everything moves. And in the same way with the property prices going down, if the top end of the market is seeing a massive haircut in prices, that's going to ripple its way down the market as everybody adjusts downwards, and the whole stack of the ladder, kind of the rungs move down a little bit as everybody has to reestablish what this house is actually worth, this property that I'm sitting on is actually worth. So we call it, a house price crash, a house price dip, whatever you want to call it. But actually, functionally, it's just a readjustment for everybody downwards in terms of that pricing point, which I think, as we're going to come on to in a bit, it's not necessarily bad for everybody, and it depends on the way in which you view that asset and what you ultimately want to do with it, right, as well. Because it's like, if you need somewhere to live and you rent, but you want to buy and you've got a cash deposit, well, suddenly you might be in a position finding yourself you're able to afford a bit more than you were a year ago, 2 years ago, because house prices have had to readjust. What I think is really interesting now at this point is, I think, like I said last time, I think the market's really tight. I think a lot of people are just sitting on their houses waiting for things to get better, waiting for rates to improve or whatever it might be. And actually, but there will actually come a point where people have to start selling because they've actually got to move or they've actually got to cash in to pay for their retirement or whatever
Yeah,
it is they're
life
planning.
catches up with us eventually, right? There's
Right.
only so much you can stand still.
You can only delay it for so long. So I think we're at that point, that inflection point now where owners are probably going to have to start readjusting their expectations of what they think they can sell their property for. And you see it already. Like I keep an eye on places like Rightmove, and a house will appear and it'll sit for 3 months and then it'll disappear and then it'll reappear with a different agent. And then, eventually after 6 months of it not selling, the seller realizes, well, I've actually got to sell this now. I'm going to have to offer it for cheaper. And you see the prices come down. And I think we will see more of that. Let's move on a little bit now, because I think what's difficult with the kind of talking around a property price crash and all this kind of stuff is a lot of what we're discussing is very anecdotal. A lot of the data doesn't reflect very well as to what's actually going on out there. But there is definitely a sense that something's not right. So this begs the question, firstly, who does this impact the most? And I think I touched upon it there a little bit, and I think it's fair to say it's possibly good for first-time buyers, but there's a big caveat with that, right?
Well, yeah, I think the only thing I would say with that is interest rates are still pretty high. So
Yeah.
yeah, it will make that jump, that the amount of money you need to get on that ladder smaller in theory, but it's still a major undertaking.
Yeah.
It's a relieving of certain pressures for sure.
There's potential, yeah. And I mean, if you look at that against kind of rising wages and that kind of thing, things have, relatively speaking, over the past few years gotten more affordable. And that is, I mean, this is the economics here are the higher interest rates are, the more that depresses asset price growth. So that's why property prices went crazy in the last decade, is because we had zero interest rates. So people were able to take out cheap loans and buy much bigger properties than they would have either, when you're buying a property and paying 1% interest on your mortgage, you're able to get a lot more for your money, assuming you're able to afford that, assuming you're able to pass the affordability criteria for that mortgage, than at the moment paying 4%, basically, because purely speaking, you have to spend more money on the interest payments. So that means you're able to afford, less house effectively. And that ultimately has the impact of depressing prices, at least making growth slower. The potential big loser, and this is the reason why I think we're probably going to see some action. If things don't improve in the market, well, we might see some action, and we'll talk about where that action might come from, is people who are looking to use their homes to fund their retirement, which unfortunately is probably more people than anybody is willing to freely admit. Property wealth in the UK is such a big portion of everybody's overall wealth. It's a huge aspect of it. And obviously a lot of people don't think about their home in terms of property wealth, but when you do the sums, often at times it makes up a big proportion of that. So let's say somebody has decided not to put their money in ISA, has only put kind of nominal amounts in their pension. All of their wealth has gone into their home because that's the easiest way for somebody to save. It's the easiest vehicle for somebody to save into because you're paying a mortgage. You kind of just get on with it. The problem becomes, if I had a house that was worth £500,000 and my plan was, okay, well, I'm going to sell this for £500,000 and I'm going to move into a bungalow by the sea that costs 200 grand and I'm going to use that 300 grand to fund my retirement income. Suddenly, if that house is selling for £100,000 less, you have a big problem because a third of your retirement plan is gone. And this for me is the real thing that nobody talks about, but is the potential, the disaster zone stuff if we get into the territory of a serious property price crash, correction, whatever you want to call it, where people who are looking to fund their retirements through their property are suddenly facing a massive, massive problem. Because the first thing they'll do is they're going to sit on their house for as long as possible, basically trying to delay the reality of that and hoping that the market will pick back up and get back to where they want it to be, that kind of thing. But the other problem is at the other end of it is if these people suddenly have a lot less money in retirement to use or to draw upon from their property. And this is not the only way people do it. People use things like equity release. That's pretty common. Lifetime mortgages are retirement interest only mortgages. Those things are growing as kind of tools that people can use. Suddenly this presents the government with a problem because the government has to pick up the tab when people can't afford their own retirements, be that through state pension, through pension credit, all that kind of stuff. And this is where I see the crux of the reason why government policy tends to support house prices, is because so much of our economic system is predicated on house prices just going up forever.
Yeah,
So as
you
soon as
talked about the wealth thing there. It's a
Yeah.
huge part of our wealth. Sorry to cut across it, but
No, it's okay.
it's massively, massively skewed towards that at the moment. And yeah, I think you're right.
The good news is that for younger people, there's much less of that. Obviously, the big problem we have for younger people is they're not getting on the property ladder. They might be renting in retirement, which is a problem. But the positive, and we've talked about it lots, is that people have more focus on their pensions and they have more going towards their pensions. And that needs to be the central point of their kind of retirement. And that was the whole point of the auto enrollment reforms and revolution, that taking away the emphasis from property being such a big part of people's retirement calculations. So this brings us to the issue then of if the government is worried about this happening, they may or may not be at this point. We're not sure because they don't tell us. And then who else is going to be worried about it and who might do something? Now, Chris, I don't know what your thoughts are on this. I'm not sure at the moment that the government's going to do anything until we have a really much more serious problem.
Yeah, I feel like I don't want to get into it, but I saw something really interesting from
Mm,
uh, Christian May at City AM recently talking about the jobs market. And I feel like this is in a similar bucket. And I don't want to go off subject, so I won't go too far down this rabbit
mm,
hole. But this idea that there's some problems that aren't immediately visible at the moment,
mhm.
but that are, I think, bubbling up. And if you're someone in the Bank of England, for example, on the Monetary Policy Committee, you'd like to think that you have foresight of these kind of things and would therefore seek to reduce the pressure and free up some mortgage funding to try and get the market moving again. It's fair to say the summer are the quieter months as well in the mortgage market. So
Yeah.
how much of a headwind is that? But ultimately, I think there needs to be an ability to try and free up capital a bit more to get things moving. So I think the pressure will probably be going on in those committee meetings. The Monetary Policy Committee at the Bank of England, who
Yeah.
set the
Yeah.
interest rates, will be thinking about, or the base rate will be thinking about that, and should be. And I think you said last week, actually, but I know you put a comment out to the media talking about the fact that actually they've been sitting on the fence and doing a bit of wait and seeing themselves. Maybe the time is to be a bit bolder with that. But I understand inflation is a spectre in the background that if they do cut rates and inflation spikes again, we're kind of back to square one. I think it's really interesting what their next decision will be. What do you think, Ed?
Yeah, I agree. I mean, I think with on the government side of things, they've just kind of got rid of the stamp duty relief that were in place for a while. I don't think they're going
Mm.
to go back on that because they have a lot of kind of challenges with how they're paying for stuff at the moment. Everybody's aware of that. I'm not sure that, there's much road talking about what they may or may not do. I think you're right that the focus now is going to be on the Bank of England, what the Bank of England decides to do next. Let me break this down into two parts. What I think they should do and what I think they will do. I think, and I'm very much a rate hawk. I've always been of the belief that when interest rates were really low, I always thought they should be higher. Now I think things are worse than anybody's admitting, and I actually think they should be lower. And actually, I mean, this is a toxic mix because you're not going to help inflation by doing that. But then it's creating so many other issues elsewhere that I think it should probably be low. We should be just going lower in order to stimulate economic, growth or whatever at this point, especially as on the fiscal side, taxation and that kind of thing is so tight.
How low should we go, Ed?
Well, it's never going to go back to zero. It should never go back to zero, but it should be, I don't know, call it 3% or something like that.
Okay.
It should. The problem is the inflation. But I think the problem that we have is that so much of the data, and actually the ONS yesterday published a whole thing about how they're having to review all their data and they're working on a timeline which is still years and years in advance on how they're going to fix a lot of the statistics that are broken at the moment. The problem we have, and particularly with employment figures and wage data and that kind of stuff, it's all so backward looking.
Yeah, that's an issue. It really is because it feels different. We
When
can
you look
sense
at
it.
yeah, when you look at jobs data and all the stuff that comes out, that was happening months ago. That's not what's happening today.
Mm,
That just tells you what was happening 3 to 6 months ago
mm.
in terms of a timeline. That's no way to conduct policy.
It's not even reactive. It's reacting
No,
to a situation that's passed.
you're
It's
reacting to things that have already happened a long time ago.
mm,
And this happened in 2022 when they got behind on inflation. They were slow in reacting because they were just sitting watching data tick up.
mm.
I think the indications are that the job market is not good. The wages are coming off the boil, excuse me, and that they need to probably do something about that. Because as soon as that stuff all feeds through, and sure, there's some like structural inflation problems that have come through because of things like tax rises and that kind of stuff. Actually, I think inflation is probably not as bad as they're saying it is. It still feels terrible because nobody's earning enough money. But we're at this point now where something needs to fall over in order for us to get back up again. We can't just keep limping onwards like this, and it's like as a society we've we opt not to go for the sharp pain, but it just creates a chronic problem that never goes away, kind of thing.
I think it's a good way of putting it. Yeah, we just end up limping on, like you said, because we're carrying all these niggles with us.
Yeah, it's just all going to come. I think the big thing here is it's all just going to come to a head eventually. Now, in terms of, and I said I would say what do I think they will do as opposed to what they should do. Uh, I think they'll just kind of like hobble along, and I think we'll get to, January 2026, and things will look absolutely dire. But the irony is that things will probably already be improving, and they would have missed their entire chance to have any kind of influence on the whole thing. It's just the whole thing, it's all happening in retrospect, and where do you is kind of. I don't want to start getting exasperated on the podcast because but I think that's where we are now.
Yeah. So what does this mean for you?
For me,
Back to part 2, you called this, of the house.
yeah.
Help, my house price is falling. You've got pressure to move, right? You have
Well,
literally having someone on the way. It's like,
Chris, I'll tell you what my plan is. My plan is to absolutely perfectly time this so I hit the sweet spot where house prices have gone down loads.
if I back anyone to do it, Ed,
Well,
it'll be you.
I've still got enough time on my mortgage to have that nice low rate before the big ones kick back in, and then I get the new mortgage on the lower rates once the economy is totally bottomed.
There we go. He's nailed it, everybody. There
There
you
you
go.
heard
That's
it
what
here
we do.
first.
I,
No,
I think that might be a bit of a risk, but anyway,
I'm
there we go.
giving a less. I'm gonna my less flippant answer is that you can't time it. There's no point timing it. You need to get on with your life, and you need to figure out what you can do with the cards that you've been dealt. So
Have a
we
plan.
have a plan. So we're going to get on with it. We're not moving immediately. This is probably next year we're talking now. So hopefully the picture will be different in 6 months to what they are today. If you ask me if I were to do it now, it would be kind of fine, but I would be doing that in the expectation that the house I'm buying is probably, the house that I would go to buy is probably going to come down in price almost immediately because of where we are in the market cycle, etc. But my house here has already come down already. What difference does it make at this point? It's just moving the rungs of the ladder down. I'm on the ladder. I need to stay on it. I just have to figure out how to step from one bit to the next kind of thing. So it's more of a practical problem for us. I think ultimately it's what your situation comes down to, what you can afford, and what you feel like seems sensible at this point in time, and not making rash decisions on the basis of fear. A crazy idea you might have or whatever, sometimes it pays to be bold, but also it pays to try and understand, the reality of your situation as well. Have a plan, like you say.
I think another interesting question it brings up, and I'm not planning to do this anytime soon, but it is a conversation we've had, is about improve versus move. Is now a good time if you've got some cash to increase the value of your home
Yeah.
with, by adding a loft extension or something out the back or a side return or, sprucing it up. You talked before about the floors that you need, in the previous pod, tidying that up ahead of a sale, that kind of thing. It's like, well, is there any benefit in doing that now? Because inflation is always going to be there, so probably never going to be a cheaper time to do it. The problem is, well, I'm not planning to move, and got a lot going on in my life anyway, so I might not necessarily want to start a huge project like that. But I think it's quite an interesting question in terms of what could you do, what are the options, and if it's not quite right, and you've got some cash on the hip, is there a way for you to improve where you are now, which could ultimately benefit you when things kick back in the other way around and you've got more equity in a property and all of a sudden your mortgage deal's slightly better and fast forward 3 years and you're in a far better position? Don't know the answer to that, but I think we can get someone on who can help us to get the answer to that, Ed. So I will go and find somebody who can tell us what the practicalities of that are, because I think that's another option here, Why don't you stick a massive extension on your loft, Ed? That's what I'm saying to you.
Because I'm not going to put my in-laws in it. That's the main thing. We're moving to be closer to the in-laws.
A really nice loft extension.
I don't want to put them in the attic, right? That's a bit too close.
Something a bit Harry Pottery, that, isn't it? It's a bit too close. You said you want to get closer. There's no closer.
Keeping them in the attic.
Yeah, exactly. And only letting them out to babysit.
God, I hope they don't hear this.
I apologise. It's me saying this, not Ed. Just
over
the next Sunday dinner.
You're right. I mean, one of the big things I've learned owning a home for 3 years is actually if you sit still on it and you don't do anything with it, after 3 years, everything starts to look a bit scuffed and tired. And actually, one of the most important things you can do is buy a can of paint each year and paint over those scuffs and keep things looking neat and tidy. Like the thing I learned with the wood floor, like I need to, and I was doing that last night. I was putting beeswax down on our hardwood floor, Chris.
Wow.
That's the level of
People say Thursday nights are dead.
that's the
Not with
level
eggs
of
around.
yeah,
There we
that's the
go.
level of detail I'm going to now. Like
Do
I've
you do it
cut
with a beer in hand at least, or?
absolutely not a glass of wine.
Sorry, I do apologise.
Thinking man's DIY.
Exactly. Beeswax, my God.
Yeah, beeswax. It waterproofs it, so because it's in our wood floors in the kitchen, so it waterproofs it moisturizes and waterproofs the wood. There you go.
There you
Top
go.
tips. Get a
Amazing.
little bit of everything on the Mouthy Money podcast.
There you go. That's it, Ed. We're going to have to do Ed's home improvement tips shortly now. I can see the
that's
series
exciting
coming on. There you go. That's
Yeah,
good.
yeah. Brilliant. I think that about wraps it up. As Chris said, we're going to do lots more around property market, mortgages, that kind of thing, because it's the super interesting area at the moment. There's a lot going on. We are going to look more in detail on this home improvement stuff, I think, come in the future. So do subscribe and give us a follow in the kind of relevant places to keep up to date with that if you're interested in it.
If anyone's got
Obviously,
any questions as well, sorry, Ed, about
yeah.
specific situations, do let us know.
Yeah, we do. So we have a panel of experts who we can draw upon who can answer questions for kind of the audience. So please do get in touch with us. The best email for that, actually, if you want to get in touch, is editors@mouthymoney.co.uk. Perfect place to give us a shout out and ask a question, and we'll help you with that as much as we can. I think that about wraps us up. Chris, thank you as ever.
My pleasure. My pleasure.
And thank you everybody for tuning in. We'll see you all again very soon. Thank you and goodbye. Thank you for tuning into the Mouthy Money podcast. Don't forget to hit like and subscribe on all our content. Follow us for more on your preferred podcasting channel, including Spotify, YouTube, or Apple Podcasts. Stay in touch by following our social channels on Instagram, TikTok, and LinkedIn. And don't forget to subscribe to the Mouthy Money newsletter on mouthymoney.co.uk. The Mouthy Money podcast is produced for general informational purposes only. It should not be construed as investment, legal, tax, or other forms of financial advice. If in any doubt about the themes expressed, consider consulting with a regulated financial professional for your own personal situation. Past performance is no guarantee of future results. Investments can go down as well as up, and you may get back less than you started with. Never invest more than you can afford to lose. For more information, visit fca.org.uk/investsmart for more. Thank you.